Following a lot of big economic news this morning, from signs of a recession to the interest rate hike. First, though, markets opened just a few minutes ago. So a live look at the big board here. We're 4 minutes in, and we're up just about 43 points. So not a huge increase to start things off, but still starting off in the green at least.
Yeah. Also new this morning, the U.S. economy shrank at a 0.9% rate from April through June. This follows a 1.6% drop last quarter. 2 consecutive negative quarters for the gross domestic product, or GDP, are traditionally seen as an indication that the economy is in a recession. However, economists note that the job market is still strong and wages are up. Now, the Federal Reserve has raised its key interest rates again. It's part of an effort to try and ease inflation. So a lot of people at home wondering, what do we make of this latest hike?
Yeah, so joining us now is financial coach and author Michael Quan. Good morning, Michael. Thanks for being here with us.
Good morning. Thank you for having me.
Okay, so let's get right to it. We know that high rates means it's going to cost a lot more to borrow money. So how will that stop inflation? What's the Fed's goal with doing this again?
Absolutely. So one of the tools that the Fed has is to increase rates to really help curb inflation. So we're all feeling that today, right? Higher costs at the grocery store, going out to eat, and just filling up your gas, right? It was like $100 yesterday for my car. It's crazy. So the Fed is raising interest rates, and that's not necessarily a bad thing. It's actually a good thing because the inflation numbers for this past June came out at a whopping 9.1%, and the Fed's actually trying to target 2%.
Oh, wow. Okay.
So what does this mean for people at home? How can they spend their money wisely, so to speak?
Absolutely. So there's a few different things to think about. And first of all, as interest rates go up, we have to be cognizant of the APRs for credit cards, because that's going to actually go up as well. So anytime the Fed raises interest rates, we're going to see this trickle down through the mortgages. We're going to see it come in through the APRs and credit cards and other vehicles like car loans. So we really want to be aware of how that's going to affect us and our bottom line.
Okay. So the Feds want to prevent a recession. Of course, that's the ultimate goal, bringing down inflation. But we just saw our economy shrink again by just under 1%. We just reported that moments ago. Some say we're already in a recession. How are we gauging that? I mean, are we in one, in your opinion?
Yeah, that's a great question. And you just saw it, right? We just reported today that the National Bureau of Economic Research said that we're in the second quarter of negative GDP growth. And so with that, we are somewhat in a technical recession, but the interesting thing is that we're still at a very low employment rate at 3.6%. So that's something to look at. And so by certain means, it's not necessarily meaning that we're in a full-blown recession. So keep that in mind as well.
Now, we want to obviously stick with the idea of how to manage your money. And when speaking about, obviously, interest rates, a lot of big-ticket items come with those, homes, cars. Is this a time now to avoid the housing market, to avoid maybe purchasing a car, obviously if you need one, but like those big ticket items, avoid those right now?
Yeah, personally, I think I would suggest doing exactly that and being patient. And the reason why is as interest rates go up, it's going to put downward pressure on prices. And so if you're able to be patient, you can wait for the supply to increase and the prices will naturally go down. Right now, as you can see, if you go to the lot, it's very expensive. There's a lot of people trying to buy these cars. So if you can wait a little bit and have some patience, you're going to get a much better deal.
I am curious if you have any insight onto how long we should wait. I mean, when do you think prices will go down, we'll get better deals? Is it months or years?
That's a great question. I'm thinking months, but it could be a year. And we're going to likely see the Fed continue to rise their interest rates over time. And so as we see that, again, the cost of borrowing is going to become much more inhibitive for people. So there's going to be a much smaller pool of people that are be able to buy the cars. And if that's the case, then all of a sudden the price is going to go down because there's less people willing to buy the cars.
Which we're almost now seeing too with our housing market as those prices are dropping little by little.
We're seeing exactly that in the housing market, and we see it in the last year. The price now is literally almost double what it was before.
Michael, before we go real quick, just any advice to anyone who's seeing all these numbers and worrying, maybe panicking? I'm sure you're seeing that a lot in your industry. What would you like to say to them?
Yeah, you know, one thing that you can do is definitely think about your budget. And it's not about really constraining, but being mindful of how you spend your money. And if there's something that you want to buy, like a car, right, maybe you delay that and you push it out and take some time to really think about, okay, when is a good time to do that? And because the dollar is not going as far as it once did, consider picking up some additional streams of income, maybe pick up a side hustle or get some extra shifts at work and try to really help to mitigate some of these effects of inflation that we're seeing today.
Okay. All right. Well, thank you so much, Michael. Appreciate that. Yeah.
Thank you for your time this morning.
Yeah.
We know there are a lot of companies that are hiring right now, too, so that side hustle, not a bad idea.
No,
Maybe
not
a
at all.
second
Yeah.
job if you have the time and can do it.